Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good day, Lower Alabama, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks you for joining us today. We're excited to have you. Josh Knoll here, joined by the one and only Michelle Lee Melton, the Bugs Bunny to my Daffy Duck.
Nice.
The David Bowie to my Mick Jagger.
Yes.
Michelle, how you doing?
Ziggy Stardust. I'm doing well. I'm busy. We had Snowmageddon here a couple of weeks ago.
We did.
Which was amazing. And I
and
loved
everything
that.
shut down. And
everything shut down. It was great. I had a work
including
week
this
that
recording
consisted
studio.
Of,
so sorry, listeners.
Yes, including all over the town and Baldwin County, state of emergency.
That's right. But we're back.
But I worked 1.5 days that week.
You did.
So I love this new work
better
week.
than I did then.
Yeah.
Well, so Michelle, did you notice I said I changed the opening a little bit?
To the coast, the Gulf Coast,
yeah,
Lower Alabama?
Right.
I did notice
I didn't do good afternoon like normal. That's because...
Oh, yes,
right,
an announcement. Ding, ding.
Yes, you have to stay. Listeners, stay tuned. We got some very exciting news for our little radio show.
That's right.
But for now, we're back in Coastal College's recording studio, beautiful downtown Fairhope, ready to put together another great show for those of you tuning in. Listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you today. First segment, deep dive on our topic of the day. Second segment, roughly 25 minutes past the hour. That'll be Michelle with the headlines of the week. And then roughly 45 minutes-ish past the hour, stick around for our third segment. We call it Joshua's Crystal Ball and Big Mouth. So buckle up. We've got a lot to get to. Quick background on me for those of you new to this show. My name is Josh Knoll. Again, I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call, 251-327-2124. Now, if you just missed that, contact info, get a pen and pad ready, because we will repeat it several times throughout the show. All right, so back to our big announcement. Michelle, you know I like big announcements. I like grand pronouncements. I like three-syllable words. So
or even more syllables.
You're right. Let me just tell you, we got some huge news for the Coasting in Retirement radio show. So first, a little background for those of you that haven't tuned in regularly. This radio show began way back in December of 2022. Can you believe that? That's our first episode.
What is today? Okay, yes,
this is January.
Okay.
Well, February, excuse me. Yeah, I can't even get there.
All right.
February 2025. So it's more than 2 years. That entire time, we have been a proud member of FM Talk 106.5's slate of weekly shows.
That's right. Thank you.
Weekend show. Thank you. And we plan on continuing that relationship for as long as they will have us. But guess what, Michelle?
What, Scuttlebutt?
We are adding a second radio station to our... That's right. So in addition to our regular Sunday time slot on FM Talk 106.5...
There's more.
Starting this Monday, Coasting in Retirement is also going to be broadcast on WHEP.
Ooh la la.
That's the Talk of Baldwin.
Okay.
Yes, WHEP is Coastal Alabama's longest running station.
Nice. Way to go, us.
Right. And our show will be aired, those of you listening on 92.5 or 1310. You're hearing us every Monday from 10 to 11 a.m. Central Time.
That'll make Mondays better for
yes,
the listeners.
100%. It's a great way to come right out of the gate. We're right after the one of their most popular shows. WHEP broadcasts out of Foley, and it should be a great opportunity for us to expand our presence in South Baldwin and continue to grow our Orange Beach office.
That's right.
Which Pedro Cardozo is working out of right now full time. So for those of you WHEP listeners tuning into our show, we welcome you. And Michelle, I thought you'd be very excited to know that WHEP is the Auburn Network's longest running affiliate.
Love that.
67 years.
Eagle.
There you go. Very
Heck
exciting
yeah.
stuff. I thought you'd love that.
I
saved
do
that
like
for
that
you.
a lot.
All right, well, let's get to our main topic of the day.
Let's do it.
We titled this episode, Slaying the Stock Market Boogey-Man.
Slay.
And based on some of the things that have happened here recently, the timing couldn't be better. So let me start with a question. Michelle, would you agree that fear sells?
Absolutely.
Okay.
I'm not sure why, but it does.
At the very least, it's one of the many techniques used by
tactic,
marketers,
yes.
right, to sell a product or service.
Oh, yeah.
And unfortunately, fear selling is now it's used in a lot of different industries, but it's also used in my line of work as well, financial advising and financial services. And more often than not, it's fear-based selling intended to invoke a certain apprehension about the stock market, typically, in order to, more often than not, sell an insurance product. So, right? So listeners, you may be asking, well, how would selling the fear of the stock market help someone sell an insurance project?
I'm wondering that too, Josh.
Oh, we are going to answer that question for you today. And in the process, hopefully we'll help you all overcome your fear of stock market investing so that you aren't leaving thousands of dollars of potential gains on the table. And probably more importantly, or as important, being steered into products that often benefit the insurance company and the selling agent more than it does you.
Boo.
So, Michelle, we got two major things to accomplish today. First, we want to walk you listeners through a brief history of the stock market, demystify some of the myths around it, and we're going to use some of the major indexes as our guideposts, tying in how those index milestones impact the gains and losses in your investment accounts, those of you listening. And then second, we're going to take this historical data and show how some advisors, agents, and representatives in my industry, in my opinion, unnecessarily stoke the fear of investors, especially those of you in or near retirement, in order to sell an insurance product and more often than not generate a large commission, upfront commission. We're even going to give you the products these salespeople most often use in the typical the typical sales pitch things that they say, so that you can be prepared with this information next time you attend a annuity timeshare sales dinner. A no obligation educational event.
There you go.
Held at a local restaurant.
Riveting.
Yes. Now, Michelle, you and I were both born in the 70s.
Heck yeah.
But I think it's fair to say we're really children
That's
of the
when we
80s.
grew up. Yeah.
That's when we grew up. Yeah, we were both mid-70s.
Totally tubular.
I'm way older than you by, what did we determine? I'm 22 months older than you.
That's a long time, Josh.
Is that right? Yes.
Yeah.
All right. So we're children of the 80s. So for the sake of time, we said we're going to do stock market history. We're going to start with that decade. We're not going all the way back to when Wall Street was a tree and they were buying and selling pieces of paper back and forth underneath the tree. We're not going that far back.
Was that a thing?
It was. That's how it started.
We need to do that.
Yeah,
we need to do some history of
well,
that
we'll
at
go
one
further
point.
back at some point because you and I both love early American history.
I do.
Right. Also, for brevity, we're going to narrow our scope of guideposts down to three primary measurements of overall market performance, what a normal person would call indexes.
All right.
We're going to use the Dow Jones Industrial Index.
Familiar.
The Dow Jones Industrial Average, the S&P 500.
Also familiar.
Right, and the overall composite index of the NASDAQ. That's going to be the broadest one, okay? Now, for those of you confused by what a stock market index even is, let me boil it down for you because it's a fairly simple concept. A stock market index measures the performance of a certain selection of stocks. I'm going to say that again. A stock market index measures, because Michelle likes to hear me say measure, the performance of a certain selection of stocks. Some indexes, like the Dow Jones we just mentioned, only have 30 stocks. A lot of people don't realize that.
Dang, I thought it was
only 30.
3,030 or something.
The S&P has 500. Or S&P 500 has 500. Makes sense, right? And then the NASDAQ composite that we mentioned, that tracks all the stocks trading on the NASDAQ platform. No matter the index, the goal is to calculate the goal of the index is to calculate the value of those selected stocks and present it as a single number.
All right.
Got it?
Mostly.
All right. Well, you're going to get it when we get done with this segment. All right. So let's start in the 80s. All right. You ready?
Yeah.
Yes.
Woo.
Now, I've told this story.
Far out.
I've told this story a million times, and those of you all that were adults in the late 70s and early 80s, rest in peace, Jimmy Carter. But I remember my dad coming back. My dad was an excavating contractor, and back then I think he was mostly building houses. And he was all excited as excited as my dad gets, that he had gotten an interest rate somewhere around 11 or 12% from the bank for a construction loan. Right?
Yeah, but okay.
And it burned in my brain.
The houses cost $25,000.
That's
you know.
That's true. And it wasn't too long after that the 80s kind of changed. You can credit Reagan if you want to, but I think it's
Reaganomics.
Reaganomics. The 1980s were characterized by significant economic growth and the emergence of the bull market. You know, greed in a word is good, right? Gordon Gekko, Wall Street, all of it, right? There were some key events during this decade. There was the implementation of deregulation. Oh. There were tax cuts under the Reagan administration. Yeah. And there was advances in technology. I mean, the world that Michelle and I entered into in the early 80s was way different by the time we exited in the late 80s. Fair, technology-wise.
Atari.
And so the stock market responded positively with major indexes experiencing substantial gains. Let me give you an example.
Okay.
The Dow Jones Industrial Average in 1980, the starting value was 824. Okay. At the end of the decade, at the very end of 1989, the Dow Jones Industrial Average was 2,753. That is a 234% return over that time period.
Boom, shakalaka.
Okay. How about the S&P 500?
How about it?
It started at 106. These are funny numbers now. 106, ended up 1989, 353. That's 233% gain.
Yep.
And the NASDAQ composite, which is, the NASDAQ was just kind of still a little bit of a toddler then because it started, I believe, in 1971. It was the world's first electronic stock market exchange. But its value was 164 in 1980 and ended in 1989 at 454 for a 177% gain. Now, to give you all an idea where the discussion is headed today, even with NVIDIA taking a gigantic dump this week, which we're going to talk about in our headlines of the week, and and impacting the NASDAQ specifically, the NASDAQ at the beginning of 1980 it was 164. You know what the average has been hovering around here the last couple of weeks?
Okay. Well, the average was 164.
It was in 1980.
Okay. 2,840.
20,000.
Okay.
20,000.
I got a 2 in it.
We're going to work our way up to that. So 20,000. All right. This is where this is heading. Now, I would be remiss to say that even though we're going to be talking about these decades, Michelle, and the fantastic gains that everybody had, all investing involved risk. We'll repeat that several times so that people don't think you can just throw a dart at a dartboard and this always works. All right. Let's get to the 1990s.
All right.
Yeah, right. You and I are in high school. Right?
That's right.
Early part, and then going to college.
Yes.
Yes, living
Yay,
grunge.
College. Grunge is in.
Grunge
Love
is coming
it.
on.
Grunge
I don't.
music.
I couldn't stand it, but it was popular.
Baggy jeans and tank tops.
Yeah, that's right.
Doc Martens.
Flannel.
Love
I'm not
it.
a flannel person.
I'm not a flannel person either. I like the tank tops.
All right, so here's what happened in the 1990s. We got the rapid expansion of the internet, and again, more tech. Tech's just leading the way. And that eventually led to what most people you would refer to as the dot-com boom, or what eventually became the dot-com bust. The stock market soared as investors poured money into tech companies. The decade ended on just unprecedented highs, right? So here we go. You remember what we said the end value was in 1989. So the starting value of the Dow Jones in 1990 was 2,810.
Okay.
So there must have been like one day of trading in between those two values, right? It ended at the end of 1999. The Dow Jones Industrial Average was 11,497. That is a 309% gain over that 10 years. Crazy.
Biggest number yet.
Right? And I believe we were in a Democratic presidency for 8 of those years, right? We were.
Well,
Clinton. Yeah, Clinton served 2 terms there. Not to introduce politics, but
did he serve
he
2
did,
terms?
yeah.
Okay.
He served 2 terms.
All right.
The S&P 500 started at 330, ended at 1,469 for a 345% gain. And in the 1990s, the NASDAQ kind of coming to its own, starting the year at 454, that numbers matches from our previous example, ended 1999, 10 years later, at 4,069, a 796% increase. If you had bought nothing but the NASDAQ composite for the entire decade of 1990, you would have had a nearly 800% gain on your investment during that time period.
I think it's interesting that one ended the 80s and began the 90s on the very exact number, and the other ones did not.
I think there must have been.
Did it just close down for a few days?
Well, it does, yeah, actually. So NASDAQ can, and there's over the counter. We're getting to Nerdville real quick here, but the rest of the markets tend to have a more traditional working and trading time period.
Oh, okay.
All right, so now we're into 2000s.
Woo!
Right?
All right.
The dot-com bust.
That's right.
The good times are over.
I lived in Denver, and it was a sad place in some situations.
It was sad everywhere.
Well, there was a lot of .com nerds.
That's true. Yeah, you had a high percentage
Boulder
of tech.
was churning them out. And,
tech bro, right?
Yeah.
2000, anybody that was alive during then, we had the .com bust. Which
splat.
I didn't have. I was just right out of college. I didn't have any money.
I was in law school. I definitely did not have money.
It really didn't affect me. I just remember playing basketball, and there'd always be these guys that seemed like they had all the time in the world. I'd always ask them.
Lower downtown Denver, Lodo. Yeah.
And I'd ask, like, what do you do for a living? Oh, I'm a day trader. And it wasn't very long after the .com bust, I never saw those guys again. I'm dead serious. So we got major indexes getting smoked, both in .com bust. Then that's followed up not too long after by the 2008 financial crisis or the housing market crash, right? Now that one I did feel.
Yes, you did.
Right? So let's talk about this. This is really interesting. You remember the percentage gains that we had over the previous 2 decades, right?
Ooh, not so good in this decade.
I'm going to spare you the numbers, Michelle, because we got to keep the show moving. But the Dow Jones Industrial Average from the beginning of 2000 to the end of 2009, the end of the decade, it actually lost 9%.
Whoa.
Right? The S&P 500 went down 24%, and the NASDAQ Composite lost 44% of its overall index value during that time period.
Big.
Because it was most heavily invested in
sure.
tech stocks, right?
Yes.
Now, this is the decade, we talked about annuity timeshare dinners, right?
Yes.
This will be the decade.
Those are educational
opportunities,
opportunities, Josh.
These will be
with mediocre food.
unless it's mine. We'll talk about that. Now, this will be the decade you'll see illustrated on PowerPoints during those annuity dinner sales seminars. I know this because I tried to do one. It didn't work because sometimes
Your food
was excellent.
We have a nice caterer.
Water Oak was excellent.
Yeah.
But, when you want to tell people the straight skinny, you need time and context like a radio show versus when you're trying to razzle-dazzle people in a 30 minute. I'm not geared that way. But I will tell you that generally speaking, annuity salespeople are going to use the 2000s because it's often called the lost decade. Mm-hmm. And especially for you investors that were in tech, it was a very rough decade. But if you had just given up on stock market investing at the end of this decade, what would you have missed? Let's take a look. You ready for 2010?
I guess, yeah.
All right.
I'm trying to think what I was doing.
2010. You were getting ready to meet me. Well, no, that was years later. Okay. All right, 2010 was marked by, it's a decade of recovery and growth. So we recovered from the financial crisis, some areas a little quicker than others. We had a period of economic growth. We had bank policy, again, tech's in there, globalization, which I would argue has been a huge contributing factor to the positive performance of the stock market.
Agreed.
And whereas we ended 2000 and the first decade of 2000s ended at the end of 2009. This, you're going to love this. So 2010, from 2010 to the end of 2019, Dow Jones up 174%.
All right, back to the good numbers.
Right.
Okay.
S&P 500 up 190%.
All right.
And NASDAQ, here it comes back, 295% up to an ending value of 8,973. Remember what I just told you?
It was 80s and 90s years.
Right.
So.
Okay, now. Here we got one more partial decade to get to, the 2020s, what we're living in.
All right, we're in 2020s.
So we got the 2020s. We got COVID, right? We've got historic market volatility. We've got governments jumping in to stabilize the economy in ways.
Maybe not the best idea.
Right? I mean, you could argue because they didn't do it in 2008, and you saw what happened when they did it for the banks. I will say the one thing they changed about COVID is they made sure that the average person got a lot of money in their pocket. The problem is that led to a lot of fraud, but you could probably argue the banks did some fraud of their own back in 2008 and 2009 anyway. But whatever they did, it worked because there was a rapid recovery of the stock market. And I'm talking about stock market. I'm not talking about the overall economy.
Sure.
I'm talking about the stock market. There's still concerns. There was ongoing concerns. Obviously, the inflation, that's still an issue. Supply chain disruptions, particularly during COVID, and geopolitical tensions. All this matters. But even so, now, I'm going to tell you, Michelle, the numbers I calculated, I only had numbers to the end of 2023. But let me give these to you, and then I'll update you on what's happened since then. From 2020 to the end of 2023, the Dow Jones was up 17%.
Tiddlywinks.
The S&P 500 is up 31%. Now, remember, that's with a huge COVID sell-off and drop.
Okay, whatever.
Right?
Still, I don't like those numbers compared to the other ones.
Well, yet your expectations are pretty high then. And the NASDAQ Composite was up 43% during that time period. Now, again, note, listeners, that was the end for the 2023. At the beginning of 2025, where we're at now, the Dow Jones has hovered around 44 to 45,000 in overall index value. The S&P 500 has closed above 6,000 a few times.
Okay.
And as we mentioned earlier, the NASDAQ Composite has been bouncing around 20,000 on many trading days. So again, let's go back. I'm going to tell you one last time. In 1980, the beginning of 1980, the Dow Jones was 824. It's now around 45,000. The S&P 500 was 106. It's now at about 6,000. And the NASDAQ was at 164. It's now at around 20,000. Now, does that mean you've made 20,000 times your investment? That's not how it works.
That would be nice.
Right? What it means is it's a general indication of if someone that has stayed the course and been invested in the broad market, particularly in these indexes, it gives you an idea of some of the gains that you've seen over this time period. Now, what has happened since then is if you take out the double whammy of the 2000s with the dot-com bust coupled with the housing the housing market crash, what you had is of those 3.5, 4 decades, you've had one decade where it was pretty rough going. And you and I, again, we were kind of in our young formative years, and we paid attention to that. So again, particularly me with the housing market crash. But for those of you all that were scared of the market during that time period, particularly for you all that were adults and investing during that time period, think about the numbers that I just listed off to you. Is that a guarantee that the next 35, 40, 45 years are going to be the same run-up? No. Past performance is not indicative of future performance. But what we're talking about here is when you're looking at what you're trying to do with your investments and what is the best way to grow them over the long term, it has been mathematically proven, not just in the last 4 to 5 decades, but throughout the history of the American stock market, that the greatest opportunity for the quote-unquote retail investor to experience the most upside appreciation, albeit with some with downside risk, is to invest broadly in the stock market. Get it?
Got it. We hear that a lot. I'm into it.
Right. Now, what you're going to hear, especially those of you in or near retirement, from the
insurance guys?
From the insurance guys, particularly the fixed index annuity guys, and we'll circle back so we'll be a little more fair, because right now we're picking on them. We're trying to close this segment. But what you're going to hear on the fixed index annuities is that you get market participation with no downside. That's not 100% true. Or you get market-like returns with no downside. Again, that's not 100% true. That may be somewhat true in the short run, but that is definitely not true in the long run. The gap gets too wide. Or for some of y'all that are looking at these products and there's an upfront bonus that, unfortunately, a lot of times it's called free money. Again, that's not 100% true, because there's always a trade-off. That free money, quote-unquote free money, is usually tied to some type of lower performance or longer elimination period that's more or less buried in the writing of the contract of the fixed index annuity. So I want you all to think about these things. Like there's nothing particularly wrong with using fixed index annuities as long as they're used for the purpose they were designed for. The things that we're trying to talk about with you all today is don't let fear selling of the investing in the stock market be one of the main determining factors for you parking some, or a lot of times a significant portion of your wealth into an illiquid and tends to be expensive product such as a fixed index annuity, which any longtime listeners know is the product du jour. Is that how you say it? The product du jour of our industry right now. Any questions on any of that? Does that make sense? What do you think of those numbers? Isn't that cool?
I mean, I get discombobulated with how much numbers getting thrown at me.
Well, one number is way bigger than the other.
Clearly.
I mean, way bigger.
But they're all transposed in my head by now.
Okay.
All I know is that,
we'll keep chipping away on that.
Compared to what it was in the golden years when we were growing up. Now that it actually matters to us because we're making money and have jobs and are trying to save money, it's like, great. Yeah.
Well, one last thing was to close this segment.
We are living longer.
And last time I'm going to pick on if a financial advisor says that he or she is confused about understanding hear me out, about understanding the positions listed on your investment account statement,
maybe don't use them.
You should be very concerned about what direction the conversation is heading, right? Despite my economics degree from the Harvard of the Midwest, Missouri State University, I still don't necessarily have the level of sophistication as, say, maybe a Wall Street trader would, but I can look at pretty much any investment statement and decipher what your investments are within a few minutes. And if I can't, that probably means that you've got some weird stuff in there. So if you'd like to have a free, no obligation checkup on the investment choices in your retirement account, or maybe you just like to have an honest and open, no BS, no sales pitch conversation about your goals and dreams and how those goals and dreams tie into your overall financial retirement plan, then we encourage you to give us a call. You can reach us at 251-327-2124 or visit our website, gulfcoastfa.com. That's Gulf, like Gulf of Mexico, or Gulf of America, depending on what you're picking.
Well.
Coast, FA is in financialadvisor.com.
King cake!
Yeah, on our site, you can choose to send us a direct message, or you can click on the blue button in the upper right-hand corner. That will set up a 15-minute introductory phone call on my calendar. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week, we scour the internet for financial articles related to our topic of the day. Special articles that pertain to those of you in or near retirement. So join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News Headlines of the Week. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour what she calls the interwebs for financial articles related to our topic of the day, especially articles that are pertaining to those of you in or near retirement. Our job, or at least we think it is to help you all understand how these headlines impact you, especially when it comes to your money. Now note, if you want to read our referenced articles yourself, we include the links in our show transcript, which you can find on our website, gulfcoastfa.com. Just look under the podcast tab and find the episode you want to find a referenced article link. Without further ado, here's Michelle with the headlines of the week.
Okay, Josh, our first article is from wealthmanagement.com titled, "Don't Fear the Froth. Stay invested even if stocks are overvalued." In our opening segment, we only went back about 45 years into the stock market history, which is enough. But according to this article, a study showed that from 1928 to 2022, the S&P 500 was in bull market territory 78% of the time, which I believe means that 78% of the time, the S&P 500 was rising in value. Is that correct?
That is. There's some broader math to it, but I mean,
okay,
for simplicity, that's correct.
Let's go with simple. Okay. So, given that simple math, then 22% of the time would have been a down market, referred to as a bear market.
That's right.
Okay. Whatever the animal, this article states that history shows the stock market grinds higher far more often than it backtracks, and most investors should take a long-term outlook when it comes to investing. What do you say to clients that are very concerned about being prepared for the 22% of the time that the market is down, especially if there is a sharp kersplat crash?
Well, so we earlier in the episode, Michelle, we picked on the annuity sales dinner, right?
Yes.
And I'm telling you all that typically if they're going to pick a decade to show you how crappy things can be for your investments, they're going to pick the 2000s. They're just going to. And to be fair to them, they're not entirely wrong.
Sure.
Because
we saw the numbers.
You know, if you had two people that had identical portfolioos, and one retired in 1990 and one retired in 2000, they would have radically different outcomes if they invested the same way.
Sure.
They would. That's a mathematical fact. So when it comes to that, especially for those of y'all that lived through it, like somebody like me that was a home builder during that time period, I can see where you would be concerned about 22% is almost a quarter of the time where things can get a little rough. And bear market doesn't necessarily mean a market crash. It just means the market's trending down for 2 consecutive quarters. But most people are going to associate their fears as they're in or near retirement that they come into it and they have a sharp downturn, possibly a crash, or maybe they go experience a lost decade of the 10 years that would have been the 2000s, and now their $1 million or $1.5 million or $2 million portfolio has made money. It's lost money, right? Mm-hmm. So I get that. And on top of that, there's going to be drawdown risk. You know, what happens when you take money out of an account when the market is down?
Sure.
It just means percentage-wise, you've got to make a higher rate of return to get that money back. And sequence of returns risk is where if you have down markets year after year, quarter after quarter, it can have an outsized impact on your portfolio. But again, as Michelle said with the title of the news headline, as you're looking with the stock market and you're looking at your portfolio, you should be having a conversation with your advisor about which part of your money in your accounts should have a particular jobs. And one of the jobs of one part of your portfolio should be for long-term outlook. And for that long-term outlook part of your overall investment portfolio, then we're going to have a conversation about your risk tolerance and comfort level with stock market investing, because over time, as we just detailed, nearly 50 years, and that's just recent, there's actually some really good returns. We could go back in the early 1900s and show there's no guarantee the market's going to always cooperate. There's no guarantee the market's always going to make gains, anything like that. But if you look at the overall history of the stock market, it has been up and to the right as often
Yeah.
grinding it out there,
Yeah.
but just like you said, Michelle, but it's been up and to the right
Stats
over time
Stats
with
turn to
downturns.
positive vibes
That's
towards
right.
the stock market.
Very good.
Yeah.
What you got next?
Okay. Next up, let's visit with our old friends at Kiplinger's. They have a recent article titled Why Annuities Sometimes Sound Too Good to Be True. I think the title would have been more accurate by stating fixed index annuities, because we talk a lot about those, and the article does too. This article discusses the differences between income account values and cash account values, which apparently are not the same thing.
They are not.
Which I put in my notes too.
Yep.
Even though some salespeople will point to the 7 to 8% number used to calculate the income account value and say that this is the, quote, guaranteed, unquote, rate of return for the annuity. I reread this paragraph several times and I'm still confused. And to be honest, I'm not even sure if saying something like this is even legal, right? Because people take it, run with it, and then whatever, you get sued. This article also cautions investors about the lure of big upfront deposit bonuses or high initial interest rate offerings, because they have to make it up in the end somewhere else. So Josh, with all of these potential trapdoors, how do investors navigate the fixed index annuity sales process?
With your eyes wide open. Okay.
Boom.
So one of the things you said there that is what they're saying is illegal when they're offering guaranteed rates of return.
Because no variables.
So
and stuff.
listeners, I'm going to tell you, it's really important on how your financial advisor is securities licensed, if he or she is securities licensed or not. Because as Michelle knows, I hold a securities license.
Yes.
At one time, I held several. If I were to come in, and whether it's a product or a stock or any type of investment, as a securities fiduciary-based licensed professional, if I were to guarantee a rate of return, that would be a fantastic way to lose my license very quickly. When you don't have the securities license, when you're just a life insurance licensed person, and I'm not trying to cast shade here, but they don't have these as sticky or strict of rules. And what you'll find is they will twist these things to some degree. I've had people come in and say, my guy guaranteed me 8% return. And I pull out and I go to the income writer and I say, you're getting a guaranteed 8% payout. There's a different, listen, listeners, this is really important. A lot of times if they ever say guaranteed 7 or 8%, they're not talking about a guaranteed 7 or 8% return on your money. They're talking about a guaranteed 7 to 8% return of your money. That means you're going to have certain built-in factors there. They're going to juice up the income production, and that's good. But it's not. Most people hear that and they think, "Oh, I'm getting 8% with no risk. This is fantastic." There's not. If they did that, Michelle, there's not an investor on earth that wouldn't buy these things.
Right.
Right.
And you're not getting 100% of the gains either, even when they say that.
And longtime listeners know that I have a particular irritation with this, because the problem is it's not the product itself. Albeit that you could argue that it gets overly complicated, it's not really the product itself that's the issue. It's how they're sold.
Right.
Because fixed index annuities have a purpose. Capital preservation, some potential upside, maybe even possibly more upside, a little more upside than a fixed rate of return that you would see on a MYGA. They have downside protection. That's legitimate. And they have various riders, like the income rider I just mentioned, that could be extremely valuable in retirement. The problem is that they are sold as a perfect investment, as a golden ticket, and the numbers are often fudged to make them sound better than they are. And I'm telling you all, man, the guys that do the index stuff, a lot of times they end up apologizing as years go on, Michelle. I'm telling you, because it never works out like it's illustrated.
I'm just having a flashback of torts in law school when they would have advertisements that read satisfaction guaranteed. People took them to court. I mean, I don't know if you, so you can't say stuff like that.
You can't say stuff like that.
And plus, we're very litigious.
We are, yeah. All right, what's next?
Okay, number 3. Our next article is from our friends at Aptis Capital Advisors. Hey, guys. And can be found on the blog section of their website. It's simply titled, How Do You Define Safe? And is written by Aptis founder J.D. Gardner, who has appeared as a guest host of this radio show a handful of times. J.D. discusses inflation and the practical effect on consumers' purchasing power, but also dives into how monetary supply and deficit spending should be the true benchmarks for investors' real return goals. He makes a pretty compelling case for owning growth assets, of which stocks would be the most well-known option for investors. I know you and JD have discussed these investing principles at length, so I'll turn it over to you to make the case that what investors often view as safe money is in fact the opposite. And one of my notes too said, I think he writes in here, is the appearance of stability does not define safety.
Yeah, that's right.
I liked that.
Well, and so a couple of things, listeners, especially those of you who are newer to the show. If you want to hear more about what J.D. Gardner at Aptus has to say, go to our catalog on our website, gulfcoastfa.com, go to the podcast tab, and he's been a guest a couple of times. He does an excellent job. His firm, Aptus Capital Advisors, is not affiliated with my firm, Gulf Coast Financial Advisors, but they serve in what is technically called a sub-advisor role. So they help me with all of my clients' investment accounts and portfolio management, and they do an incredible job. They help make me look great, and they help me have time to focus on financial planning, which is what I really love to do. The article, I went ahead and bring it up because it directly ties into what we're talking about, is what is considered safe. If you look at this, what JD does a really good job of talking about is what is actual return versus what is real return, nominal versus real. Because a lot of times people will look at interest rates and they'll look at inflation rates, and that's fine, but they don't take into account the increase in monetary supply that our country has experienced over the last several decades. In fact, Michelle, and you and I talked about the stock market over the last 40-some years. The monetary supply of the United States has increased on average 7% every year.
7.4.
Thank you. 7.4, very good. Percent, that's every year over the last 40 years. That's a huge number, too.
Yeah.
And so money is like water. It wants to go somewhere. And a lot of times it will go into various equities. It does. It wants to flow somewhere.
Or into shoes.
Yeah, in Michelle's case, into shoes. So on this article, especially for you all that are sophisticated investors, this will be, you'll love what he's got to say here. And last thing on this article, he does a little, since we're doing some history, they have a chart here, Michelle. It's a cumulative after-tax dollar inflation-adjusted gain on if you invested $1 in stock, overall stock market, in was 1924.
Ooh,
where would it be now? Be close to $500. If you'd done $1, you'd done $1 in bonds, which is considered safe. Yeah. That's great. $1 now, $500. That's a huge return.
From 1928.
Well, we're talking about $1, right?
Jeez.
But if you've done it in a bond, if you'd done 10-year Treasury, you would have gained 7 cents.
Oh.
Okay, so there you go.
All right. Stocks better than bonds for assets.
Well, they both have a purpose.
That's right.
It's just that we want to get people to be thinking about sometimes what is being sold to you or pitched to you as safe may not, by definition, lose money, and that there is some comfort to that, but your opportunity cost is too great. You're leaving too much on the table.
Big.
Yep.
All right.
We got time for one more?
Okay, our last article of the day, Josh, found on Barron's. It's titled NVIDIA stock.
NVIDIA,
that's how you say it, not NVIDIA.
I know, it's weird to look at.
It's okay. I
always think of that kid's movie, Narnia. That's what it always reminds me of Narnia.
That's true.
But it's not Narnia.
No,
it's NVIDIA.
Not. It's NVIDIA stock, and it is dropping.
Yeah, this is the headline of the past week for sure.
So NVIDIA stock is dropping. Why? It is sitting out the chip rebound.
Mm-hmm.
Okay. So here's what I learned this week along with every other retail investor. Apparently a company in China called SeatGeek. It is SeatGeek.
I don't think it's SeatGeek.
I don't think it is either, because that's where we get tickets to sporting events.
Okay.
Okay. Or Daisy Jones and the Six or something.
I don't think it's a Fleetwood Mac knockoff. I don't think it's that either.
That show.
It's
okay.
Deep Seek.
Deep Seek.
Yes.
Okay. Well, okay. All right. And DeepSeek successfully developed an AI language model for a price tag of, a mere $5.6 million.
That's right.
While it has taken American companies billions and billions of dollars to develop their own models. This news caused NVIDIA's stock to drop a whopping 17% on Monday alone, spooking many investors about the future of AI and causing a significant drop in the NASDAQ. So here's my question to you, Josh. Why is everybody freaking out so much over this? And what's going on?
Here's what's funny, Michelle. 17%, compared to all the numbers we just listed earlier in the show.
Tiddlywinks.
It was almost $600 million drop in their overall market capitalization, their overall market value. Is that crazy? It's the largest single company. I mean, we haven't had many companies worth $600 million.
Right.
So what it means in particular, you mentioned the $5.6 million thing for DeepSeek. It means that, honestly, investors are being fooled on either one side or the other. Here's what it means. Why the market freaked out is either our large tech firms, think Meta, think Microsoft, think Alphabet, think all the companies that, the big seven, magnificent seven, Either our large tech companies are wasting billions of dollars on AI development, on something that could be done cheaper, or possibly China is pulling the ultimate troll job. One or the other.
Distinct possibility.
Right. Because my first reaction was, okay, where'd we get this number from? 5.6 million. So I get it. Like China, we curtailed the sale of NVIDIA chips to China because of their AI technology capabilities.
Correct.
We thought that would handicap China in producing AI that can compete with us. We want to get ahead. And here comes China, basically shopping at Dollar General and putting together the cream, the nicest meal ever for a discounted price and saying, look how good this is.
So a little bit of reverse engineering, do you think?
I think there's a couple things there. And, for our folks that are listening that are from China, this is absolutely no offense to you all.
This has nothing to do with you.
This is really about the CCP. I do think that, and I think it's fair to say this, historically, China has intentionally, it's not like they hide this, they've intentionally went after and plagiarized our various tech companies. That's not a secret.
No,
that's not. I'm not doing slander here. I think
they're actually proud of it.
They're actually proud of it. Thank you. And they also they have more involvement with the government and their private sector. One would argue that we've got real involvement now, but historically they have more involvement. So there's going to be a certain governmental prop up of a lot of these industries. I.e., see the car EV market in China and see what it's doing. If you really want to be spooked and alarmed about our auto industry. But back to the point is this $5.6 million price tag is probably, maybe it's real, but it's totally out of context. I can promise you that.
All right.
And we've already seen the market kind of absorb this news and regroup and move forward, because it's not just the chips, it's not just the actual computer programming, what they call the language models, but it's all the power that has to be generated to produce this massive amount of data compute and all these things.
Nuclear power?
Well, China's recently brought on 10 nuclear plants. They got 10 more going, and we are not keeping up. Argument for another day.
Right.
But there's just all these things. Right now, as much as crypto tends to dominate the news, AI is the 8,000-pound gorilla in the room to crypto's little monkey. And that's just a fact.
True.
Right? And so it's really what is the overall value of a huge, significant chunk of the overall value of the stock market is tied up in these AI-producing companies. So that's why everybody freaked out. Very good. That's it?
That's it.
All right. Well, listeners, I hope you learned something from our discussion around these recent financial headlines. And we'd argue all this matters to your money. Speaking of money, if you'd like to start the conversation with us about your investments and your retirement planning, then why don't you give us a call, 251-327-2124. It comes to me. I know when radio show leads call in, and I'll often answer.
Correct.
Yes, it's fun. You can also reach...
Even in rainforests.
Even in rainforests. I did. That was fun. Costa Rica. You can also reach us on our contact page on our website, gulfcoastfa.com. While you're there, don't forget to click on the blue button in the upper right-hand corner. That will put a 15-minute introductory phone call on my calendar. If you do put that on there and you want me to call you, make sure you spell that out and have your phone number listed. Otherwise, I'm assuming you're calling me. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong? I don't think so. How wrong? What do I think is going to affect investors in the near future, maybe the distant future? We talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host Josh Knoll here, alongside co-host Michelle Lee Melton.
That's right.
So I'm opinionated. I have strong opinions at times. I would say a radio show host that isn't probably wouldn't be very interesting to listen
Boring.
to. And I'm paid in my profession to offer professional guidance and opinions to my clients. Otherwise, what use am I? Just replace me with AI.
That's right.
Right? I like making predictions, and while I feel I'm usually proved right, there are times where I swing and miss. So if you want to hear me eat a little crow, let's get at it with Joshua's crystal ball and big mouth. What you got, Michelle?
Okay. It's still early in a new year.
It is.
And we've already picked on your big mouth and misfires from last year. Maybe it's
There were
time
several.
to
You can find it in the past catalog.
reload the cannon and blow out some new predictions for 2025. And let's tie it into our topic of the day. First, we discuss three major stock market indexes: the Dow Jones, the S&P 500, and the NASDAQ Composite. I'm going to round off on where those indexes currently sit. About 45,000 for the Dow, about 6,000 for the S&P, and approximately 20,000 for NASDAQ. Where will those three be at the end of the year 2025, Josh? We've also discussed on previous episodes about sales totals for fixed index annuities, which we talked about today again, and how every year they break a new record, including a whopping 125 billion.
That's crazy.
Last year, a 31% increase from 2023. So, also, what are your predictions for the total FIA sales?
Guaranteed 8%.
Quote unquote guaranteed 8%. Got it. Writing it down.
All right, so let's talk about this. So we got the Dow Jones at 45,000. Now, I think you'll find this interesting, Michelle.
Okay.
And I know you don't sit there and stare at computer screens all day.
I do.
Well,
but
at the stock
different way.
market,
Yeah.
right? But when Nvidia took a gigantic drop earlier and on the Monday and dropped 17%, the Nasdaq Composite was hit very hard.
Yeah, sure.
The S&P 500 was hit very hard. The Dow Jones,
Cruising.
they not that they're not all still industrial, but the Dow Jones Industrial Average tends to be a little bit more blue blood, a little longer standing.
Sure.
Right. So if you were somebody that were heavily, a lot of times people say it's a double-edged sword. It'll go both ways. Like with Nvidia, they'll say, "Well, I want to be part of these tech companies. I want to own a piece. I want to own Nvidia, and I want to own Microsoft, and I want to own Tesla and all this stuff." And I tell them, if you own a S&P 500 index fund or Nasdaq Composite fund or any type of indexing fund, the majority of them are going to have these companies' stock in there. Right. So a lot of people saw, especially if they were aggressively invested, which means they were probably heavily concentrated in growth stocks, which means they were heavily invested in tech stocks, they probably saw their 401k and their IRAs and their investment accounts get binged up a little bit, right? Which gives
I'm glad I didn't look, and I don't look.
Yeah, you don't. You got a long time horizon, right? You're so young. You got a long time till you retire.
I like the way
But that kind of stuff gives the fixed index annuity guys a lot of ammunition. So
I know better.
where are we going to be? All right. So listeners, lean in close because we're going to have an adult conversation here. This is going to be an adult conversation.
Okay.
I have no idea where we're going to be at the end of the year. But I will tell you this. Here's what I think.
It's just predictions.
I know it's just predictions, right? I think that
Nostradamus.
I agree with J.D. Gardner that as long as the United States still continues to operate deficits and has to print money and has to increase monetary supply, that money is going to look
money.
that money is going to look for a place to be, and a lot of times that's going to go into investments. I agree with that. So I don't think that's stopping anytime soon. Again, we're having an adult conversation here, folks. There's not a political statement. Some of the things I'm about to say. I think that you're going to see this AI thing be very interesting playing out. I think you're going to see this you're going to see this political environment, particularly around tariffs. This is not a political show. I will tell you that some things I agree with the current administration, some things I don't. I do think trying to encourage more manufacturing in the United States is a good thing.
I like that
but
too.
It's going to
do
take
that.
It's going to take time, and honestly,
buy more California wine, people.
Fine, and the stock market's probably going to have a little bit of an adverse reaction to that, because we are a country of consumers. So to answer your question, Michelle, I think at the end of the year, it's going to be scratch and claw, and we're going to eke out some gains in all the indexes. I think we're going to experience quite a bit of volatility, right? And especially as geopolitical events happen around the world, and we have Jerome Powell with the interest rate, the Fed funds rate. I think you're going to see quite a bit of knee jerking and head swiveling. And I would tell you all, if you want to have a plan that makes volatility an asset class, you need to talk to us, because there's no way to just make a stock market investment portfolio perfect. But there are things you can do to account for the fact that we are probably going to be in some more heavily volatile times when it comes to investments. And then, sadly, for better or worse, Michelle, I think fixed index annuity sales, I will put a number on this.
Okay.
I think they'll go to $150 billion this year in 2024.
150.
And part of
okay,
that,
it's 125, so okay.
And part of that is the fact that there's just more people. The baby boomer generation is retiring, and some of the older part of our generation is retiring. There's just a lot of money out there, right? And they make an appealing argument that, hey, the argument they make is protect your downside and have a little market upside. And if they're just saying that, I'm fine with that. But I can't tell y'all how many times somebody comes to my office with a very different story they've been told about what the product's been put in front of them. So, all right. So there we go.
Okay.
I think the markets overall are going to be up. I think it's going to be rough.
Scratch that down, listeners.
There's going to be a lot of volatility. And I do think if FIA annuity sales and annuity sales in general are going to continue to increase. So we'll check back at the end of the year. The table has been set.
Yes.
Right.
I wrote it down.
Did you? All right, do this. I think NASDAQ will end the year at 22.5.
All right.
22.5. That's what I think. All right, so folks, while we wait on, as we get through this year, we'll see how accurate I was towards the end of the year. In the meantime, if you want, one last time, we invite you. If you want to have a free, no obligation conversation on the investment choices in your retirement accounts, if you'd like to have an honest and open, no BS, no sales pitch conversation about your goals and dreams and how to tie those things into a comprehensive financial plan, then give us a call. You can reach us at 251-327-2124. or through our website, gulfcoastfa.com, or on our site, you can choose to send us a direct message, or you can click on the blue button in the upper right-hand corner. That'll put a 15-minute introductory phone call on my calendar. And also note, folks, we have 3 offices to meet. So if you want to meet in downtown Fairhope, we have an office there. We have an office off Canal Street in Orange Beach, and we have an office off Dolphin Street over in Mobile, off of I-65 and Dolphin. So we got 3 very convenient and very nice locations to meet. Folks, that's it for us this week on Coasting Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton.
Very welcome.
Thank you to our show sponsor, that's Providence Partners and Jay Stubbs. Thank you to our longtime and very awesome radio station, FM Talk 106.5 out of Mobile. And a huge welcome to those of you just tuning in on WHEP 92.5 FM and 1310 AM. Just so happy to be here, so excited to be coming to South Baldwin in a new market. We can't wait to meet all you people and really encourage you to listen to the show. Many thanks to the producer or provider of our show music, that's local band Sloth Racer. Huge thank you to our show producer, that's my son, Peyton Knoll. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be part of your journey as well. Till we talk again next Sunday or Monday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.